So even though he was absolutely right on the market and the market continued to go higher, volatility declined, eroding the premium that he paid for that option. So that's an example of a strategy that you do not want to use in a high volatility environment. Even though you're absolutely right on the direction of the market, there are certain strategies that you don't want to use in order to profit from that market. Take a look at our SPY chart here again. And let's go into a daily chart just for 5 months and take a look at the most recent weekly chart for the past 9 months. Now, what we want to do is determine, based on this, the current state of the volatility of the market. Now, we could simply go over to the VIX, which is a measurement of the volatility of the market based on the S&P 500. So we could do that. Let's take a look at the VIX. Let's get a little bit of a longer time frame in here. And we can see that it's currently trading at 26.38. Not terribly high. I would say anything over 30 is probably high volatility, and anything under 30 is relatively low volatility. Now, the market has had a bit of a rally in the last few days, so the VIX has come down to the 26.38 level. Although it doesn't tell us a whole lot. It tells us what the current level of the VIX is, and you can there's a very subjective judgment that you have to make about whether or not it is high or low. Subjectively, I think 30 is above 30 is high and below 30 is low. But that really doesn't give us much information about the current state of the market. Instead, what I prefer to do, and what I told you before, is that I prefer to use bars themselves to help me determine volatility of the market based on the range of the bar and the trading for the week. So what I tend to do is I will measure this bar using the drawing tools available to me in the trading system that I'm using. I take this bar and I use it as a measurement against the previous bars to find out if it's equal to or greater than or less than the last few bars that have traded. In this case, we're talking about the last few weeks of SPY. And if I take a look at this and I measure it up against all of these previous bars going back many, many, many bars, it looks like, and then we have one bar that's less than the current bar. It looks like this is the smallest weekly bar than the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20 bars, the last 20 bars. That's pretty significant. So we have a bar that has a less of a range in the weekly trading than the last 20 bars. So it appears to me that volatility is going to be decreasing, or at least it's going to stabilize. It may not decrease, but at least it looks like it's stabilizing. So how should we trade this if we think volatility will decrease? Well, number one is we can't go by a single bar. So a single weekly bar is not going to help us decide to trade. Instead, we need some confirmation that in fact volatility will be declining. In order for us to make that determination, we need to wait until an additional bar is created. And ideally, what we'd like to see is a small pullback on lighter volume. That will give us the confirmation that we need that volatility will probably be decreasing and the SPY will continue to go higher. So that's what we need to see before we can make a determination if, in fact, volatility has receded for the time period that we want to trade. Now, we could have made the same assumption going back here. If we use this as an example, we had a decline, right? We had a decline into this period here, volatility rose. You can see that the bars relative to each other were relatively small range bars until we got here when we had a very large range bar on an up day, and then we had a very large range bar on a down day with increased volume. That gave us a clue that this week was the beginning of a higher volatility period in the market. Now, when there's a higher volatility market, and previously we've had a low volatility market, what happens to option prices? Well, if high volatility inflates the price of premiums for options, low volatility will lower the price and deflate the price of premium in options. And if that's the case, then we can pick up options extremely cheap. And so at this point, we would be looking to purchase put options. Because number one, the premium is relatively low because of the low volatility, and number two, we expect volatility to increase, and with increased volatility, normally the market declines and declines rapidly. Now, there's two ways that we would profit from this event. Number one is we get to buy put options extremely cheap. And number two, we get to profit from the decline in the price of the SPY, as well as an increase in the premium because of the increased volatility in the option itself. So there's a couple different ways that we can profit. Now, what we're going to do is prove this to be true. And the beginning of the weekly chart showed on the 19th that actually it ended on a high note.